These two features save you the exact same dollar in interest, down to the cent, but choose the wrong one, and it can quietly cost you tens of thousands of dollars in tax you never had to pay. Offset and redraw. Nearly every Australian with a mortgage has one or both, and about a quarter of us admit we could not explain either one. So let me draw it out properly, because the difference is not the interest. It is where your money is actually standing. One note before we open the plans. This is general information, not personal advice. Your situation is your own, so get advice before you act. Now, here is what you will be able to read by the end. First, what each one actually is, drawn simply. Then the thing almost nobody tells you. On interest, they are identical. So the popular question, which one saves more, has no answer worth chasing. Then the two differences that actually matter. One is about control, whether you can always reach your own money and whether anyone else can freeze it. The other is a tax trap that only springs years later and can cost a fortune. And finally, honestly, which one suits which kind of person? No winner declared up front because there isn't one. Start with what they are, because the names hide the whole story. An offset account is a normal, everyday transaction account. Your salary can land in it, your debit card can spend from it, it behaves like any other bank account. The one special thing about it is that it is linked to your home loan. And every dollar sitting in it is subtracted from your loan balance before the bank works out your interest. So if you owe $500,000 and you have $50,000 in the offset, the bank charges you interest as if you owed $450,000. The $50,000 is still yours. It is still sitting in an account with your name on it. It is just standing next to the loan, quietly cancelling out part of it. A redraw facility looks like it does the same thing, but underneath it is the opposite. Redraw is not a separate account. It is a feature of the loan itself. When you pay extra into your home loan above the minimum, that extra money goes straight into the loan and pushes the balance down. Redraw is simply the bank's permission to pull some of that extra back out later if you need it. So the money is not standing beside the loan, it has gone inside the loan. You have handed it over, it has reduced what you owe, and the bank is letting you borrow it back. On the interest saving, that is a distinction without a difference. On everything else, it is the whole difference. Money beside the loan or money inside the loan. Let me kill the most common question before it wastes your time. People ask, which one saves more interest? Neither. They save exactly the same. Take that $500,000 loan again. Park $50,000 in an offset, and the bank charges interest on $450,000. Pay that same $50,000 in as extra repayments and leave it available to redraw, and the loan balance is $450,000. Same balance the interest is calculated on. Same interest, same saving to the cent. So if interest were the only thing that mattered, you would just pick whichever is cheaper to run, and that is very often redraw, because plenty of lenders give redraw away for free while charging a fee or a higher rate for a full offset, which raises the real question. If they save the same and redraw is often cheaper, why does anyone choose offset at all? For two reasons that have nothing to do with interest. The first reason is control. Because your offset money never left your hands, you can reach it instantly any day, like any transaction account. Redraw money is a step removed. You have to request it back out of the loan. It can take a day or two to land. Some lenders set minimum redraw amounts or limit how often you can do it, and a few charge a small fee each time. For everyday cash, you might touch often. That friction matters. But here is the sharper edge of control, the one that surprises people. Because redraw money is legally inside the loan, it is not really sitting there as your cash. It is available credit the bank has agreed to extend, and a bank can change its mind. In a downturn, or if your circumstances change, a lender can reduce your available redraw, or freeze it, or claw it into the loan. It has happened to real borrowers at exactly the moment they needed the cash. Your offset balance is different. It is money in a deposit account with your name on it. The bank cannot quietly reach into it and shrink it. So, the first real difference is not just speed, it is who controls the money. Beside the loan, it is yours. Inside the loan, it is theirs to manage. Now, the one that can cost real money, and the reason a tax advisor cares about this choice far more than most people do. It only springs if one thing ever happens. You move out of this home and rent it out. The moment your home becomes an investment property, the interest on its loan can become tax deductible against the rent it earns. That is a valuable deduction, and whether you get to keep all of it depends quietly on a decision you made years earlier about offset versus redraw. Here is the mechanism. The tax office does not care where an asset sits. It cares what your borrowed money was used for. Your loan is deductible only to the extent the borrowed money went toward earning income, in this case, the rent. Now watch what redraw does. Suppose over the years you had redrawn $50,000 from the loan to buy a car or take a holiday or put a deposit on your next home. To the tax office, every one of those redraws is a brand new borrowing, and that borrowing was used for private things, a car, a holiday, a home to live in. So when the property becomes an investment, that $50,000 of the loan is not deductible. You have permanently split your loan into a deductible part and a non-deductible part. Advisors call it contaminating or tainting the loan. Untangling it afterwards ranges from painful to impossible. Now do the same thing with an offset. Your spare money was always in a separate account beside the loan. When you spent it on the car, the holiday, the next deposit, you were spending your own cash. You never touched the loan, never changed what it was for, never reduced and re-borrowed it. So the loan's purpose stays clean, and when the home becomes an investment, the whole loan is deductible against the rent. Same house, same $50,000 spent on the same things, and one version quietly protects a deduction, the other version destroys. That is the tens of thousands of dollars from the hook. Not magic, just which side of the wall your money was standing on. So honestly, which should you use? There is no universal winner, and anyone who tells you otherwise is selling something. Redraw is perfectly good and often cheaper if two things are true. You are confident this home will never become a rental, and you like the mild discipline of your spare money being tucked inside the loan where it is a little harder to raid. For a lot of owner-occupiers who will live somewhere for decades, that is a fine, low-cost choice. Offset earns its keep when you want your cash genuinely at call, when you hold a meaningful balance and value the control, or above all, when there is any real chance this home becomes an investment one day. In that last case, the offset is not a convenience. It is insurance on a future tax deduction, and it is usually worth the fee many times over. So the real question was never which one saves more interest, because that answer is neither. The question is where you want your money to stand, beside the loan, in an account that is yours, that you can always reach, that no one can freeze, and that keeps every future tax deduction intact, or inside the loan, cheaper and simpler, reducing the very same interest, but handed over, freezable, and capable of quietly poisoning a deduction you did not know you would one day want. Two features that look like twins, doing the same job on the surface. One structural fact underneath them that changes everything. Now you can read it in a sentence. Offset money is yours, standing next to the loan. Redraw money is the bank's, sitting inside it. If keeping a loan deductible is the idea that grabbed you, there is a whole strategy built on exactly that line, deliberately walking debt from the side the tax office ignores to the side it helps you pay. It is called debt recycling, and I have drawn the entire structure out in another video. If this made offset and redraw finally click, hit like, it genuinely helps other Australians find it. And subscribe, because the next one takes a single money question and draws it out the same way.